There is a private company hiding in the shadows of global finance. It operates with fewer than 300 employees. That's it, just 300 people. BlackRock manages trillions with over 20,000 employees. Visa powers global payments with a massive workforce. Even the biggest banks on Wall Street can't touch this level of efficiency. This tiny group generates $10 billion in profit every single year. That's over $33 million per employee. There are bigger companies, there are richer companies, but almost none this efficient. Not by working harder, but by owning a system that works for them. It's not just success, it's a financial anomaly, possibly one of the most efficient money machines ever created, and millions of people are already inside it, without even realizing they've crossed the line. Millions of people are quietly abandoning their own country's currency and handing control of their savings to a single private company. And that company now holds $122 billion in US government debt, more than Germany itself. And here's what should make you pause. Nobody voted for this. Nobody signed a government form. Nobody asked the public if this was okay. Who pays if a system this large ever breaks? You or the generation that inherits it? Think of it like a ship already at sea. The passengers never chose the captain, they just woke up on board. The question isn't whether they exist, the numbers prove they do. The question isn't how much they have, we know it's hundreds of billions. The real question is, what happens when a private company finds a shortcut to the global financial system? And more importantly, why? $185 billion. That's how much USDT, the digital dollar created by Tether, is now circulating in the global financial system as of early 2026. Not printed by any government, not backed by a central bank, issued by a private company with roughly 300 employees. But this story is much bigger than one company. Imagine someone in Buenos Aires. Inflation is crushing their savings. Prices double every few months. Their salary buys less by the week. Then, one afternoon, on their phone, in seconds, they convert their money into USDT. No visa, no bank approval, no government permission. They just stepped out of their country's financial system without leaving home. That's the first face of Tether, an escape door. For tens of millions of people in unstable economies, it's often the only door that opens. In return for using it, they get stability, near-instant transfers, and freedom from capital controls. But they also accept a new kind of dependency. Over 30 million new users every single quarter. This isn't a niche trend anymore. From Argentina to Nigeria and increasingly in suburbs of America and Europe, the pattern is clear. People are quietly opting out of sovereign money. Tether added more than 35 million users in Q4 2025 alone, pushing the total toward 534 million, a population larger than most European countries. We are witnessing the birth of a parallel financial nation, one with no territory, no flag, but real economic power. When millions independently choose to trust a private company over their own central bank, it stops being a trend. It becomes a structural shift. And once you see it, you can't unsee the mechanism driving it. Here's how Tether actually works, and it's simpler than most people think. You send Tether $1 US. They issue you $1 USDT. Then they take that dollar and invest it primarily in US Treasury bills, government debt earning 4 to 5% interest. They keep the interest. You get stability, but zero yield. With nearly 185 billion in circulation, this has created an incredibly efficient profit engine. Tether generated over $10 billion in net profit in 2025, with a relatively small team of around 300 people. That's an extraordinary profit per employee figure. They use those earnings to expand, strengthen reserves, and, yes, increase their influence. It's like a global parking garage that charges you a small fee for safety then quietly earns rent on your car while you're away and keeps every penny of that extra income. The real twist, though, isn't just the profit. It's what that business model accidentally or deliberately created. Because when you hold over $122 billion in US Treasuries, more than many sovereign nations, your relationship with the US government changes. You become one of its largest private creditors. Now imagine the US government tries to aggressively shut Tether down. In theory, Tether could begin selling those treasuries. That flood of supply could push interest rates higher, rippling through mortgages, corporate loans, and the broader economy. Analysts call this a form of financial mutual deterrence. Neither side wants to test the limits because the fallout could hurt both. So the real question becomes, who actually depends on whom? But to understand the true scale of this, we have to ask the questions no one is asking. What is the actual problem? Many assume Tether's biggest risk is crypto volatility, but the deeper issue is structural dependency. The global financial system is now deeply entangled with a private, still somewhat opaque entity. What assumptions are we accepting without full proof? That the reserves are exactly as claimed? That a mass redemption event, millions trying to cash out at once, would be handled smoothly? Neither has been truly stress tested at this scale. Who benefits if the system stays exactly as it is? Tether's owners, who collect billions in interest. The US Treasury, which gains a massive, reliable buyer for its debt. Crypto exchanges, whose liquidity relies heavily on USDT. And even some governments, because Tether is doing much of the heavy lifting in normalizing digital dollars. What if the core assumption is wrong? If full backing ever came into serious doubt, the savings vehicle used by tens of millions could unravel fast. Digital systems don't break slowly. They can collapse in hours. Tether is solving a real problem for many people: escape from bad money and slow banking, while simultaneously creating larger systemic questions. If this continues, the very meaning of monetary sovereignty changes. What does it mean for a country to control its economy when its citizens increasingly use a currency issued by a private company based offshore? We are drifting toward a world where your financial passport isn't issued by your government, but by a corporation. Is that true freedom? Or just a different kind of cage, one with bars made of code? But there's a layer most people still miss. Tether can freeze your wallet with a single command. By early 2026, it had frozen hundreds of millions of dollars, including one action that locked over $182 million in a single day, linked to sanctions, investigations, or flagged activity. This is not decentralization. This is a private company exercising enforcement power that looks a lot like a government agency. No warrant, no public trial, limited appeal for most users. Crypto was marketed as financial freedom. Yet in this system, one entity can freeze your funds with a keystroke. Is that freedom? Or is it simply a different flag flying over the same control? So here comes the larger, uncomfortable question. Governments around the world are racing to launch their own central bank digital currencies, CBDCs. Is that purely about innovation? Or is it about reclaiming the digital money territory that Tether has already occupied? One theory quietly discussed among economists: governments may have tolerated Tether's growth, not out of negligence, but as a testing ground. Let a private stablecoin normalize the idea of digital dollars. Let hundreds of millions of people get comfortable with the format. Then, when CBDCs are ready, offer a safer, government-backed version and gradually restrict or replace the private alternative. If that's true, Tether isn't the final revolution. It's a bridge, useful for now, but one that could eventually be removed once the official tracks are laid. Of course, there's another perspective, and Tether makes a strong case. They argue they are providing a vital service to the unbanked and underbanked. Entire local economies now run on USDT because traditional wires are too slow and too expensive. From a business view, their model is remarkably efficient. By buying US Treasuries, they say they're actually reinforcing the dollar's global dominance at a time when other powers are trying to move away from it. They see themselves not as a threat, but as a plan B, a private backstop for a financial system that was already showing cracks. The truth is more complicated. Tether is simultaneously a lifeline for individuals, a powerful financial player, a geopolitical tool, and a potential systemic risk. It is not one thing. And that complexity may be the most dangerous part. So here's where we land. Three faces of the same entity. A savior for people trapped in broken economies who desperately needed an exit door. A power center, quietly holding massive US government debt and influencing capital flows worldwide. A risk, because scale, opacity, and trust form the classic recipe for crisis. The 2008 financial meltdown happened when confidence collapsed in instruments most people didn't understand. That crisis took months to unfold. A digital version, running 24/7 with no circuit breakers, could spread in hours. The question for you, and especially for your children, isn't simply whether Tether succeeds or fails. It's this. In a world where money can be created by private systems, frozen by private commands, and moved across borders in seconds, when something goes wrong, who is ultimately responsible? We may have left the old system searching for freedom, only to step into a new one where the walls are simply less visible.
We are standing at a crossroads. History shows that when a private entity grows this powerful, the state eventually does one of two things. It destroys it, or it absorbs it. The borders of the old world were drawn in ink. The borders of the new one are written in code. And unlike borders on a map, you often don't even realize when you've crossed them.
Is this freedom or a different cage?